€55 billion. That's the total amount of investor demand for the recent new bond issues from the so-called weak links of the Eurozone: Spain, Italy, Portugal and Ireland. These bond markets have had a rip-roaring start to the year, yields falling to their lowest for a long time, in some cases years. So if you haven't been part of that rally, have you missed the boat? Joining me now is Alan Higgins. He's UK Chief Investment Officer at Coutts. Alan, you haven't missed this rally, have you? Because you said at the end of last year peripheral bonds were one of your favourite investment trades for 2013.
Yes, we invested post-Draghi. We were late. We never got the very bottom in prices or the very high in yields.
Few people do.
Very few people do. But we did capture Italian bonds, yes. So we did capture some Italian bond performance, definitively. And we captured some Irish bond performance, but in a secondary way. So I have to pay credit to the Templeton team, because we invested in them, and of course they own
10%?
some 15% maybe now of the Irish gilt market. So we had some performance of Irish gilts in a secondary way, if you like.
So of these four countries that I mentioned, which one is the most attractive to you where we sit now?
I think we keep coming back to Italy. It has the best fundamentals. It has a primary surplus. So in terms, and for as long as I've been managing money, a long time, it's had debt to GDP of 100 to 120%. It's always had a lot of debt, but it's a very, very wealthy nation. It's less well understood. Household debt is very low, and of course household wealth is very, very strong. We've got an election. That's a little bit troublesome, but it looks like you've got this Bersani-Monti kind of coalition to come through. Not without risk, but Italy is where we come back to every time.
Still, on the other side of that coin, the core bond markets, you think there's a bubble for, or maybe not quite what we would term a bond market bubble, but something along those lines.
Yeah, I think it's interesting you use the word bubble, Jamie, because we were discussing it, weren't we? And it's in the sense that a normal bubble would be lots of speculative investors buying assets. But it's quite interesting is that you don't find Coutts buying 2-year German bonds, 2-year French bonds, or any other wealth managers, and I hope pension fund managers. What it really is that the central banks of the world, especially Switzerland, that's been intervening, that have been forced to buy ultra-safe assets. So then they're almost not buying them for bubble-like reasons for return. They're buying them for process. So bubble, probably no, but ridiculous. I remember when I started my career many years ago, 1980s, people used to tell me, oh, Swiss yields used to be negative. I said, no, negative yields. And now Jamie, you and I will be going, in 10 years' time, we're saying, yeah, we remember German bond yields, negative. French bond yields, Dutch bond yields, they were negative. And these youngsters will be saying, no, I don't believe it.
Let's finish up. Of course, Coutts is famously the Queen's Bank. What's she been saying about your 2013 investment strategy? Is she as wary of boons as you are?
Well, good question. So I have to say it's a matter of public record, that statement, in terms of the Queen's Bank. That's all I can say about that. And you'd be pleased to know, because I'm sure, Jamie, at some stage you will become a Coutts customer with your high-profile career here. That any client.
I hope my bosses are paying attention to this. Pay rise, please.
Yes, any client conversations are absolutely confidential, regardless of who the client is. But in general, I would say that our clients are very pleased with our performance, especially of our lower risk mandates. Our lower risk mandates are very, very strong performers within the wealth management industry.
OK, Alan, thank you very much. That was Alan Higgins from Coutts. Well, on to our chart of the day, and today it's Nokia, a volatile day today so far. Shares soaring to a 9-month high earlier after the company said it strengthened its cash position by around €800 million in the fourth quarter. But to save more money, the Finnish mobile phone maker says its board will now propose suspending its annual dividend for the first time in more than 20 years. Its shares were last down more than 4%. Positive news from the budget airline industry. Shares in EasyJet are up more than 4% as fourth quarter earnings showed more business travellers switching to Europe's second biggest no-frills airline. That was boosting sales, of course. Its biggest rival, Ryanair, also seeing its shares up more than 3.5%. That's all for today, but tune in at the same time tomorrow for a snapshot of what's moving in markets and why. I'm Jamie McGeever. This is Reuters.